Welcome to the Zandbergen Report, where wealth strategies and pop culture collide, featuring your distinguished host and certified financial planner, Bart Zandbergen.
Welcome to our show of Dream Chasers and Wealth Makers. We are thrilled to be back in the studio today with a new episode of the Zandbergen Report. I'm proud to bring in the movers, shakers, and difference makers who are passionate about sharing what they have learned and what you need to know today. And I am pleased to have with me today Ryan Issakainen from First Trust Advisors. Ryan is a CFA, which is a chartered financial analyst, and holds his BA and MA from Wheaton College. Ryan specializes in ETFs and ETF strategies. And just for just some background for the audience, so I am in the great position with what I do to have great partners, and First Trust Advisors, who have been around since 1991, are a great resource, both with people like Ryan, research, products, solutions. So I'm really honored to have you in today, Ryan. Welcome to the show.
Well, thank you so much for having me.
Of course. Well, clearly this has been quite a year for both the economy and the market and so on. And I really want to get to your area of specialty, which is themes, but you guys at First Trust do such a great job between Brian Westbury and your team there with market outlook and economy outlook. Can we start with a little bit of your position on the economy and the market?
Sure, absolutely.
Let it rip.
So we have become more and more, I would say, we still want to be invested in equities and think U.S. equities are the best positioned amongst the options around the globe. However, some of our forecasts that we had made late last year, we have become a little bit more cautious. And the reason that we've become more cautious has a lot to do with the fact that the Federal Reserve has been behind the curve when it comes to fighting inflation. And we've had this major surge of inflation that has been unprecedented in the last 4 decades or so. We haven't had anything close to this level of inflation that we've had over the last year or so. And we were calling for the likelihood of higher inflation early on because we saw how much money had entered the system. And as we think about what causes inflation, there are a lot of reasons why individual products and services, you have their prices move higher or lower, but that sort of generalized inflation, we think can be explained by the fact that you've increased the money supply so much. And the Federal Reserve has had a very loose monetary policy that has essentially allowed that money supply to grow at a rate that has stoked inflation. And the unfortunate reality is the Fed is going to have to raise interest rates to the point where they slow down economic activity and likely cause a recession. Now, that's the sort of bad news. The good news is we don't think a recession is imminent. We think a recession is probably more likely to happen at some point, maybe late in 2023 or early 2024. There is a tremendous amount of money sitting in consumer bank accounts. There is, that's partly the cause of the inflation that we're seeing. But we fortunately started at a point where, there's not a lot of consumer debt. So the household balance sheets are in a pretty good situation today. Very low unemployment today. There's not a lot that says, as you just look at the economic indicators, that we're going to tip into a recession in the near term. But because inflation is such a problem, and because we think it's going to require the Fed to raise rates to a point that it actually slows down economic growth and eventually causes a recession, that's the sort of negative part of our outlook. That being said, we think that stocks are still relatively attractively valued. Our economics team has a model that they've used for many, many years that essentially looks at corporate profits and applies the discount rate based on where we think the 10-year U.S. Treasury yield will be. Without getting into the minutia of that model too much, we still think that the market is likely to move higher between now and the end of the year. Our team just put out a piece earlier today, and today's June 21st, where we talked about the likelihood of hitting new highs in the broader market. So the S&P 500, it's less likely that we're going to hit new highs this year, and probably not going to hit new highs until maybe after a recession. That being said, we're 20% plus below those high levels, so we can still have some market recovery between now and the end of the year. But we've all that to say, we've become more cautious in our outlook, and we think that investors, there's some things that they can do to position portfolios to reflect that, and also to perhaps, as markets have pulled back, even they can take advantage of some opportunities for longer term growth, because everything has sort of been pushed down, and you've seen asset prices, especially in global stocks across the board, have gotten cheaper, apart from maybe some energy stocks. So that's, I know I've kind of given a lot of information, but that's our sort of macro outlook.
Yeah. So I actually read your commentary today. I track it every week, and have noticed as time goes on your trend toward a little bit more cautious position, which makes a lot of sense, and I do appreciate those. I think that you guys do a good job with that. Couple of things. So inflation is now what, near 9? I guess somewhere close to that, right?
Yeah, it depends on which if you're looking at the PCE deflator or the CPI, but yeah, there's 8-9% is around where we're at for the most widely followed measures of inflation here in the U.S. and there's pretty high level of inflation overseas as well.
Yeah. Do you think that there's a possibility or probability that inflation decreases by the end of the year?
I think there are parts of what has caused some of the inflationary pressure that are likely to subside. I think when we think about the costs associated with shipping and transport, the costs associated with energy, and the war over in Ukraine, some of those things are not likely to keep growing at the same rate that they've grown in the last year. So I do think that some of that will likely be reduced towards the second half of this year, and into next year as well. Some of that will be dependent on what the events are, especially related to the war in Ukraine, and whether or not that is something that gets resolved as we head into the second half of the year, or at least reaches a point where it's kind of becomes a long-term situation that is adapted to, and it also has to do with what happens in China with respect to COVID and some of the lockdowns, and figuring out the supply chains. All that to say, we do think that those inflationary pressures will lessen, but that doesn't mean we're going to head anywhere close to the 2% target that the Fed has repeatedly put out there. Is they want to get inflation back down to 2%. I think it's and views kind of vary, but I think our view is that we're somewhere around at least 4 or 5%, even when those sort of temporary causes of inflation begin to subside, because the real cause of inflation is there's just so much money that's in the system. And the image, our chief economist, Brian Westbury's got a great image or a great analogy that he has spoken about, where you think about the amount of money that is in the system. It's something that has to be digested. It's almost like
Yeah.
a python that takes a big bite of, consumes a big pig or something like that. And it's there, and it has to be digested. And that's the same is true with the amount of money that's in the system. It has to be digested, and it's just not going to go away anytime in the near term, at least in our view.
Yeah, that makes sense. You reference long-term growth and what can investors do. I think the easier question is long-term growth or comment. I think it's clear for someone with a long-term time horizon. Some of our favorite companies, right? America's favorite companies are what I would call, maybe you would agree, on sale right now for 30, 40% off. So
Sure.
It makes sense for the long term. What the other side of your comment, what investors can do today, and maybe that goes into your themes. You want to address that?
Well, yeah. So I think as you noted, there are companies that are on sale. The market doesn't wait for a recession to price in lower prices, and we've seen that pretty clearly. And everything has moved lower together. So to your point, I think that there are some for long-term investors, and I think investors should have that long-term time horizon. I think when you consider where we'll be 5 years from now or 10 years from now, the pullback that we've seen in the price of some of these stocks is pretty attractive. And so we think that you want to make sure that at the heart of your portfolio, you have those really, companies that have higher quality attributes that are going to generate earnings, irrespective of the potential for an economic slowdown. And you want to have companies that have really strong balance sheets and aren't over leveraged and are profitable and all those things that you would classically want to invest in. When it comes to some of the more opportunistic allocations, and when I say opportunistic, I'm talking about things that are maybe longer term secular trends over the next 10 years. I think there are some attractive opportunities there as well, that an investor can take a portion of their allocation and recognize that, there may be some volatility in the near term, but that is always the price of performance for higher growth, longer term sort of secular trends, secular themes. And yes, there are a few of those that I think are becoming more and more compelling as we kind of go through this really choppy environment for the stock market. And I can cover some of those. One of my favorites, though, and we can kind of take idea by idea or thought by thought if you'd like. But one of my favorites right now is actually the biotech industry. And the biotech industry, I think, is compelling for a few different reasons. But the most important of those reasons is we're at a point today where there is new innovation that's being created, not because scientists suddenly got smarter or even that research got way better, but we've got tools now, we've got technology that is enabling really, really complex and difficult problems to get solved as researchers pursue different treatments for just terrible diseases. And what I mean by that is, you think about a complex problem and all of a sudden you're able to utilize the power of machine learning and artificial intelligence to uncover relationships, to analyze massive amounts of data that you really couldn't do before. You're able to unlock computing power via cloud computing and using resources that you're accessing through your broadband technology. You're able to take your supercomputing power and unleash that to analyze data sets. And that is something that I think is already resulting in really amazing innovation, but I think we're at the front edge of that, honestly, as we think about the ability for RNA, mRNA technology and personalized oncology that's really specific to individuals based on their genetic makeup that might work for some people that have a certain genetic marker, but not work for other people that don't have that genetic marker. We think about gene and cell therapy, where you're actually able to take someone's cells out of their body and reprogram their immune system to fight a specific sort of disease, and then grow that and fuse it back into someone's body to enable their own immune system to fight diseases. These are things that were science fiction not too long ago, that were at the front edge of creating those sorts of treatments. And so as we think about positioning for growth, people don't tend to wait for a better economy to want to treat their diseases. I happen to like biotech because it tends to be a little bit less focused on the condition of the economy. You can have strong results and strong performance irrespective of the economic environment. So I think having a little bit less tie into the economy is part of why I think that's an interesting area to allocate to. But then lastly, I think when we consider the valuations of companies in that space, they've come down pretty dramatically over the last 6 months, but even they've trended lower even before that. And so when I look at some of the valuation metrics that we consider for an industry like the biotechnology industry, we're at prices that are as cheap as they've been in about a decade. And so, for those reasons and some other reasons as well, I think that is one really interesting long-term secular trend that I think makes a lot of sense to allocate to as an investor. Of course, making sure the rest of your portfolio is allocated properly in those really high-quality companies that we discussed before.
So just to be clear, this particular space, you had referenced the recession, and we talked about on sale. So are you saying that this space may be quote unquote on sale, but not reflective of the perhaps upcoming recession or the tough economy? It's on sale for other reasons?
I think it is on sale for a number of different reasons, but I think it's going to be less. The results in the near term for the industry overall are less tied to the economic growth environment that we're going to be in. The healthcare sector, broadly speaking, has often been viewed as a defensive sector because it isn't necessarily going to slow down when the economy slows down. People aren't going to wait to get their drugs to treat their disease because there's a weak economy. It's not something that they can push off like they could maybe an investment in buying a new computer or something like that. Buying the newest iPhone. If all of a sudden you've got less money because you're paying so much you're paying so much at the pump to fill your tank up with gas, there's a relationship there. There's not the same sort of relationship when it comes to healthcare companies in general. And so I think there are a number of reasons why those companies are on sale that are not just because of the coming recession that'll come some point in the next couple of years. I do think the whole market has been pushed lower. So I can't say that there's not a link specifically, or I should say in general, because there is. When valuations get pushed lower for stocks in general, it's going to have an impact on everything.
Sure.
And some of that is tied to the bond market and rates heading higher. But there are some specific reasons that biotech stocks are cheap, and I didn't mention this, but I will. One of those reasons, I think, is there's been an overhang for the healthcare sector, where investors have been concerned about the potential to have, price controls that are attached to their products. And what I mean by that is, if you think about both Democrat and Republican administrations have talked about the really strong populist message that our seniors are paying too much in medical costs, and they want to lower drug prices. And so, the most recent was in the Build Back Better plan that was sort of fizzled out in the fall, that they were going to have caps on Medicare reimbursement rates. And so that would have an impact on what pharmaceutical companies and certain biotech companies could charge for their products. Those sorts of messages, which are still kind of hanging out there now, have been a negative for investors in pharmaceutical and biotech stocks. And that's part of the reason that I think they're cheap. And I happen to think there is a catalyst around the corner that could help resolve that. And it'll come in one of two ways. One, there could be a slimmed down version of some of the elements of the Build Back Better plan that could perhaps address the cost of pharmaceuticals and biotech medicines. And I think the market just wants that to get out of the way. Once it does, I think that will actually be a positive for the industry. The other possibility, and I think this is perhaps even more likely, is that we head into the fall, and as we approach the election, it becomes more difficult to pass any legislation. And I think the most likely outcome of the elections in the fall are divided government. So I think there's a really high probability that the Republicans take the House, possibly the Senate. Of course, the Democrats hold the White House. And so when you've got divided government, it becomes less likely that you're going to have meaningful legislation passed. And therefore, it becomes less likely that there's going to be any price caps on the healthcare sector. And so I think that'll be viewed as a positive for investors that will perhaps even allow some of these stocks to have multiple expansion, meaning that they could grow even faster than their earnings will.
Okay.
So that's part of what kept stocks cheap, but I think there's perhaps a light at the end of the tunnel when it comes to healthcare stocks in general.
Yeah, that's a great rundown. Thank you. What's another trend or theme that you like?
Another one that I think is really interesting and topical is cybersecurity. You think about what's happened this year with the conflict over in Ukraine, and as investors have recognized that, wait a second, Russia happens to be the largest perpetrator and supporter of cybercrime around the globe, and that there's concerns that, well, if certain countries, the U.S., Europe, other places, support the resistance to that invasion, well, maybe Russia will launch cyber attacks on certain government entities or private sector entities. And so that's been sort of a reminder for companies that they need to make sure their digital infrastructure, their digital ecosystem is secure. And as we listen to some of the earnings calls for companies in the cybersecurity space, especially since the invasion started in February, I think it's becoming more clear that their business is actually seeing an uptick as customers, as people who spend on cybersecurity recognize that they need to make sure that they're doing everything they can to protect themselves. And so that's sort of a near-term reason why we've seen this sort of event-fueled benefit to cybersecurity. But here's the other interesting thing, in my opinion, when we think about cybersecurity, is this part of technology that is necessary as the world becomes more digital. Every industry that I can think of has become more digitally interconnected. And as we head into a slower economic growth environment, or perhaps a recession, I just think companies are going to reconsider how they're spending their technology dollars as they kind of budget for the future. You're going to have management teams sitting around the table saying, okay, where can we cut costs? Do we need to reevaluate the size of our labor force? Do we need to maybe reevaluate our ad spending because it's not giving us the bang for the buck that we need? Maybe we should push off buying new computers or laptops or iPhones for our employees. All of those things I think are likely on the table. What I think is not on the table as those management teams huddle and try to think about reducing costs, is cutting their cybersecurity spend. I can't imagine, especially in today's environment, but even longer term, as those management teams think about where they may reduce spending, that cybersecurity would be in that conversation. And so I think it's become this sort of almost non-discretionary line item in the budgets of companies and as well as government agencies, where you have to spend, and you have to not just spend, but even increase your spend, because the reality is the cyber criminals have a very strong growth incentive, and they're not likely to sort of reduce their efforts. They're going to continue to expand their efforts because they are located in places where you're not going to have law enforcement encouraging you to slow things down. They're not going to be prosecuted. They're going to be in many cases even supported. And so, as you do that cost benefit analysis and try to figure out, is this a worthwhile spend? I think that's a pretty clear case to be made for cybersecurity. So when we look at investments, I think those companies that are involved in that cybersecurity theme are going to benefit in ways that other sort of traditional technology companies may not. And so I think you're going to have some revenue stability in that particular segment of the technology area. So I think there's some attractive opportunities, as many of those stocks have gotten cheaper this year as well.
That makes a lot of sense. And when you all invest in cybersecurity, is it just the developers, or is there some tangential related companies that would fall in that category?
Yeah, so we have an ETF where we own a few dozen companies involved in cybersecurity, and we try to provide a balanced exposure to those companies that are involved in various aspects of that, of cybersecurity. Whether you're companies that are verifying someone's digital identification, whether you're securing their website, whether you're securing, the ability to spend through e-commerce. Whether it's someone's cloud ecosystem. So one of the things that I think is interesting about the cybersecurity space is, there are companies that have different specialties, and they're constantly expanding, and we're at a point today where I think we're at the early edge of their growth, but we're also at a point where we don't necessarily know who the eventual winners and losers will be. There are some companies that will be, that'll be acquired. There's some companies that'll lose market share, some that will gain market share. But just like any early stage technology, you may think but but you find out 5-10 years later that you bet on the wrong horse. Yeah. And so I think that it makes sense to have sort of a more diversified approach when you're dealing with something like that. And so that's why we have an ETF that invests across that sort of cybersecurity ecosystem.
Sure. Ryan, I know that you're on a tight schedule today. Do you have time for like a quick one last trend, or are you done?
Sure. Yeah, no, I have got more time, and I've got one more idea that I wanted to share with you as well. There's been a lot of discussion in the last few years about the energy transition, and I think that is something that we've come to an interesting point in that discussion, especially with some of the geopolitical events that have gone on recently. With the war in Ukraine and Europe's dependence on Russia for natural gas because they need to generate electricity, and we've come to a point where it's really been a test for how committed, especially Europe, is going to be to that energy transition. And I think there's some interesting things happening that are really unexpected when you think about even just 6 months ago. One recent development is the fact that you're likely to see more more electricity generated from coal-fired plants, which is not the direction that Europe wants to go. And I think that makes a lot of sense. But they're in a situation where they've been so dependent on natural gas, and as Russia, and Europe sort of break this relationship, they're going to need to replace a lot of natural gas imports into Russia, from Russia into Europe. And so they've got to figure out how to replace that. And in the near term, they are going to increase burning coal and keeping nuclear on track for a while. And I think so we're at a moment in time where maybe Europe is incentivized to reevaluate their strategy. But here's the interesting part of that conversation. The European Commission just announced at the end of last month that they were actually going to change the amount of electricity generated by renewables. Their target was 40% by 2030 at the end of last year, and they did reevaluate it, but they went in the direction of trying to increase that amount. They didn't say, well, we're going to just give up on this plan. We're actually, they say, going to have a 45% target by 2030. They propose to increase their spending over the next 5 years by about 210 billion euros on wind, solar, and infrastructure. So, I think all these trends or all these geopolitical events have maybe counterintuitively will end up reinforcing their belief that they need to transition to renewables. And there's other, high-priced natural gas, I think, is also an incentive to deploy wind and solar resources. You think about electric vehicles. Well, you've got now $5, $6, $7 a gallon gasoline for a little while, at least the next couple of years, I think. Maybe some of that will come down if there's a steeper recession than we expect, but that's incentivizing people to keep spending on those electric vehicles. So here's the interesting part as we think about, well, this trend is in place. I think the trend's going to stay in place. How do you invest? One of the ways that we have suggested makes sense to invest is actually the underlying infrastructure for those that will support those renewable assets. So wind and solar, electric vehicles, they don't play well with the existing power grid. We've seen disruptions around the country and around the world because of that. And the estimates are that over the next 3 decades, there's going to need to be something like 14 trillion with a T spent, $14 trillion spent on the power grid, making it more digital, making it more distributed, and making it more resilient. I happen to think as we consider that transition to renewables, the companies that benefit from that infrastructure, that build it out, that have the underlying components, the value chain, the construction companies, the companies that are transforming the power grid from analog to digital. I think those companies are a really interesting and attractive opportunity, because without those updates to the power grid and those enhancements, none of the other transition can take place. None of that transition to wind and solar and electric vehicles can take place. So all that to say, that would be the third theme for people looking at long-term secular growth opportunities. I think that is one area that's very attractive, that is also on sale in comparison to where it was just 6 months ago. We've got an ETF for that as well, that allows investors with sort of one investment to gain exposure to companies that are those that we believe will benefit from that trend.
That's great, and that makes a lot of sense. I want to switch gears, if you don't mind, and this will probably be our closing idea or comment. So many people talk about the stock market as being a leading indicator. I don't know if the general public knows what that means, but I know there's a fear of an upcoming recession, regardless of how deep it gets. But can you talk to the fact that the stock market may sometimes, as a leading indicator, have a good time during this session, or at least the end of it, as it leads the economy out?
Yeah, that's a really great point. And the stock market isn't going to reflect what's going on today. It's going to reflect what the overall market participants believe are coming down the road, 6 months or more down the road. And so, the pullback that we've seen in stocks reflects the belief that at least earnings are probably likely to grow at a slower pace or maybe even to start shrinking. Interest rates are heading higher, so you have lower valuations for stocks as rates head higher. But to your point, as we get into a recession and as things seem like the outlook isn't good, and those valuations are already reflected into stocks, we usually see the best buying opportunities before the recession ends. So 6 months before the recession ends are usually a really good buying opportunity. But another part of that is it's really, really difficult to time when a recession begins and when a recession ends. And so it's really tough to develop, say, a trading strategy. So you can sit out at the bad months and get back in with perfect timing. So for long-term investors, I always recommend not trying to time your investments and positioning portfolios to benefit from the environment that you think we're going to be in. But a lot of investors have this view that they can just sell their whole equity portfolio and get out of stocks, and then they'll have the right time to buy back in. And that's just not the case. And that's been proven time and time again that the best time to buy usually feels the worst. And so most people aren't able to do that. And so, timing the market is usually a fool's errand.
Yeah. Very wise words. And you actually may have already answered my next question, but I'll ask it anyway, because maybe you do have a different answer. And as we close up, I was going to ask for kind of closing comments or your ultimate lesson learned in your career your long career as a CFA.
Well, I think, I think as I reflect back in the various bear markets that I've been through in my career, the early on in my career was the .com bubble bursting and all of the fallout from that. And then, of course, I had the 2008 and 2009 really sharp correction in the market or pullback. 2015, there was a pretty nice pullback. 2018, there was a nice pullback. Of course, no one had experienced this unprecedented pullback in the beginning of the COVID pandemic. And then, here we are today. As I think about all those environments, they're all different from one another. They all have, different causes and characteristics. But when I think about the times that I've really wanted to head for the hills, or that I get calls the most from investors and clients that, should we sell? That tends to be the best time to buy. And the opposite has also been true. When everyone's feeling good and they have this fear of missing out, and they want to maybe double down on all their positions, all their gains, that tends to be a good time to actually sell. And so I think the fact that our emotions work against us is something that causes me, even as an analyst, to want to work with some investment professionals that isn't as emotionally connected to my money as I am. That's and right. So that's my main takeaway. We're emotionally connected. It makes a lot of sense to utilize an investment professional to help achieve your goals, whether you're a professional like me or whether you're just someone else who's investing their own assets.
Yeah. Ryan, we covered a lot, and I really, really appreciate your time, your knowledge, your expertise. And so I want to thank you again for being on the show.
It was my pleasure. I had a great time, and I hope you have a great afternoon.
Thank you. You as well. And I want to thank all the listeners who have tuned in. This was a lot of information. If there are questions, feel free to reach out. I'm happy to go in further detail. But for now, have a great one and cheers.
Tune in next week for the latest edition of the Zandbergen Report, Tuesdays at 2 p.m. Catch up on our recent shows by visiting podcast.bartzandbergen.com. The Zandbergen Report is also available on iTunes, iHeartRadio and Spotify. Interested in being a featured guest on our show or have a question you'd like to hear us answer? Email podcast@bartzandbergen.com. The contents of this podcast episode do not constitute an offer of securities or a solicitation of an offer to buy securities and may not be relied upon in making an investment decision related to any investment offering Access Wealth Management LLC, an SEC-registered investment advisor. Access does not warrant the accuracy or completeness of the information contained herein. Opinions are our current opinions and are subject to change without notice. Prices, quotes, rates are subject to change without notice. Generally, investments are not FDIC insured, not bank guaranteed, and may lose value.